get one thing clear. Your balance sheet isn't lying to you. Not technically, at least. But if you don't know what are you looking at, it might still deceive you. Quietly, subtly, and sometimes dangerously. In this video, I'm going to show you 3 lies your balance sheet might be telling. Lies that sound comforting on paper, but can hide problems that make investors walk away and founders lose sleep. No accounting degree needed, just a sharp eye and a bit of healthy skepticism. This is what we will see in this video. What is a balance sheet? Lie number 1. We have positive equity, so we are fine. Lie number 2. Our assets are growing. We are growing. Lie number 3. Our liabilities are low. We are safe. Again, lies happen when you stop asking questions. Of course, all of this after our intro. So first topic, what a balance sheet really is. Your balance sheet is a snapshot of your company's financial health at a specific moment in time. It has 3 main parts. First, assets, what you own. Liabilities, what you owe. And equity, the difference between the two, which is what belongs to the owners. And of course, it always has to balance. Asset equal liabilities plus equity. Simple enough. But the balance sheet is like a selfie with a flattering filter. It shows what you want it to show, unless you know where to look. Let's start with the first lie. We have positive equity, so we are fine. Probably this is the most common illusion, and the easiest one to believe. A company with positive equity is supposed to be in good shape. It means your assets are greater than your liabilities. So far, so good. But here's the catch. Not all assets are created equal, and not all liabilities are visible at a first glance. Think this. You have 100,000 in total asset, 50,000 of that is intangible assets, maybe a software's license or goodwill from an acquisition. 30,000 is account receivable from clients, and only 5,000 is cash. Now, liabilities are at 60,000, so equity 100,000 less 60,000, 40,000 euro or dollar, no matter. Positive. But if your clients delay payment, if your intangible assets can be monetized, if you are burning cash daily, that means your positive equity is a kind of mirage, a feel-good number hiding a liquidity crisis. How to spot it? So, look at your cash position, not just at your total asset. Calculate your quick ratio, that means cash plus receivables divided by current liabilities. If it's under than 1, you may be in trouble, even if your equity says you are doing great. Line number 2. Our assets are growing. That means we are growing. Assets growth sounds like business growth, but it is not always true. A startup might say, we have doubled our assets in the last year. That means cool, but let us ask, which assets and why? Sometimes asset growth means you bought expensive equipment that is underused, or maybe you overstock inventory that is not moving. You have invested in development, but revenue hasn't followed. Remember, just because the asset column is getting fatter doesn't mean your company is valuable. Worse, investors may see this as a capital stuck in non-performing parts of the business. How to spot it? Look at asset turnover, which is calculated by revenue divided by total assets. If your revenue stays flat but assets keep growing, your efficiency is dropping. Track your return on asset. A low return on asset suggests that your asset base isn't contributing much to the income. Pay number 3, our liabilities are low, we are safe. On the surface, having little or no debt seems like a good thing. We are conservative, we don't rely on credit, we are safe. Well, maybe, but maybe not. In some cases, low liabilities are a symptom, not a strength. Here is why. You may not have access to credit because your profile doesn't inspire confidence. You may be underfunded, relying only on equity, which is more expensive than debt. You may be burning through your capital because you can't take on debt. So, an investor may wonder, why doesn't this company use leverage? It is fear or inability? How to spot it? Review your cash flow statement. If you are negative and have no access to credit, your runway is shrinking fast. Measure your burn rate and your available liquidity. Evaluate if the company is avoiding debt or being avoided by lenders. And as a general rule, remember, smart debt, when used responsibly, is not dangerous, it's strategic. Lies happen when you stop asking questions. The truth is your balance sheet only lies when you stop challenging it. There's 3 lies: positive equity, growing asset, low liabilities, are half-truth. They are only dangerous when they are left unexamined. Investors don't look at your balance sheet to see how pretty it is. They look to see if your numbers tell a story that matches reality. So, do your financials support your strategy? Are you efficient, flexible, and ready to scale? And can you survive a bad quarter? As a founder, your job isn't just to build a product and to sell a product. It's to understand your business model, and that includes your numbers. As a conclusion, if you have recognized one of the slides in your own balance sheet, here's the good news. Awareness is the first step. You don't need to be a CFO, but you can't afford to be blind. Start reading your balance sheet not like an accountant, but like an investigator. What's real? What's inflated? What's missing? That's what separates good founders from lucky ones. Found it helpful? Give it a like and subscribe for more financial clarity minus fluff. And if you want to deep dive your startup's number with me, the link is in the description. So, until next time, read smart and grow stronger.